Hi, and welcome to the August 2025 episode of The Long and the Short of It, our monthly update video for the Oak Harvest Long Short Hedged Equity Mutual Fund, OHFGX. My name is James McFarland, joined by Chris Paris and Charles Scavone, and the three of us represent the portfolio management team for OHFGX. And for additional information on OHFGX, you can visit the website www.oakharvestfunds.com. Link will be in the description below. Before we get into the month of August, let's take a look at how the fund is doing year to date according to Morningstar as of the end of August. Year to date, the fund is up 11.75%, outperforming the S&P 500. OHFGX also ranks in the top 15th percentile year to date and the top 10% over a one-year period against its peer group. Now, one of our ongoing goals is to beat the S&P 500, so it's always nice to be able to say that. And with that said, let's turn to the three questions we look at every month. First, what was the OHFGX portfolio management team thinking heading into the month? Second, what key investment actions did we take during the month? And finally, how did things play out for both the market and for OHFGX? So Chris, what were our thoughts as we headed into August?
Thanks, James. When we were putting this together, it was a little hard because it was August and it's an earnings reporting season. So it's kind of a blur if you're trying to look back in time. But thinking about it, so heading back at the beginning of August, we'd come off the bottom in April. It had been a V bottom. We're in a bull market, right? It's kind of the millennials and Gen Z bull market. But we were entering the fifth month kind of off the V bottom. And we were really focused on earnings more than anything else. We're hedging a little bit because the cost of volatility was pretty low. And we were just trying to play it kind of one stock by one stock and getting prepped for earnings reports.
Okay, thank you, Chris. Then Charles, what key investment actions did we take during the month of August?
Yeah, so to piggyback off of what Chris was saying, as a continuation from the previous month, as we moved further through the earnings reporting season, we were very focused on identifying our highest conviction ideas, preferably companies that were supported by some sort of a secular tailwind, right? We don't emphasize that enough, but we're always trying to identify companies that are at least benefited by some sort of favorable secular tailwind as a means of helping support their generation of revenues and earnings. So we also used the period to cull out some underperformers, and we added several other high growth names that fit into our framework. Picking up on the idea of secular themes within within individual sectors, within communication services, we like social media, gaming, streaming services, both audio and video. In energy, we're believers in this renaissance of nuclear power to support the growing needs of both data centers and the country overall. In financial services, cryptocurrency trading is an evolving landscape. There are a lot of opportunities there. The M&A activity is picking up, and so is the IPO window is opening up. So now there's the trend back towards more investment banking activity, and that works well for the investment banking sector. Within industrials, this idea of improving the power grid, the necessary power to support regular residential and commercial use, plus all of the data centers that support the growing AI need. And then obviously in technology, artificial intelligence, robotics, and quantum computing are the themes that flow through our long positions. On the short side, we do try and be very stock specific. And it's been difficult on the short side. The environment's not as ripe as it is sometimes. But within that context, we're still focused on low-end consumer credit, potential issues there. A handful of names in vacation rentals. There's a couple in particular that also have some regulatory concerns regarding how those properties are handled. And then this idea of telemarketing of compounded weight loss drugs is an area of great interest and has been a fairly fertile area for short selling opportunities. But to get back to what I said before, to lead in, and what's unique about us is that in an period in which it's difficult to find individual short selling ideas, we don't have to force those positions on to create a portfolio level structure to create a certain net long or short position because of this unique hedging strategy that we use, the third leg of our stool, which is an indexed, options-based, actively managed market hedging program that allows us to hedge out as much or as little of this residual market risk as we deem prudent at any given time. So we have to make some decisions there, but it creates additional flexibility that allows us to implement our overall portfolio strategy in the way that we would like to do it. The cost of hedging, as Chris said, came down. We had a pretty productive hedging program. The costs weren't that high because we will try and offset portion of that cost by selling covered calls against a lot of our long positions. And so that helps optimize how we use that program. And that pretty much, I think, covered all three legs of what we did.
Yeah, and I think it's worth noting that we're evaluating all three legs of the stool every single day. That's the vast majority of what a day looks like, is looking at those three different elements.
Agreed. It was imperative to put into place the products that allow us to monitor, manage, and measure all three of those aspects in real time every day. And so that's critical to what we do.
Yeah, absolutely. Thank you, Charles.
I want to pick up on one point there on the hedging side. And we've mentioned this before. Charles mentions this a lot. You don't see the benefits of the hedging program, day to day, week to week, month to month. However, if you went back to August and looked at it very granularly, you would see the first day of August actually was like the optimal day that we had in the fund for the hedging program. And first day of August, if you look back, the S&P 500, I think, was down over 1.5%, and the fund was actually up, and it was due to the hedging program. So that was only one day, but that is like an ideal day for the hedge.
And that's what we're trying to accomplish every day to the extent that we can.
Yes.
Yep.
Okay, and with that in mind then, how did things play out over the month of August?
Thanks, James. Well, the good thing is, we made money for our shareholders. We had an up month in the fund.
Good, yes.
Always good, yeah. We were up 1%. The S&P 500, I think, was up about 1.8%. Growth stocks actually lagged on the month. The NASDAQ was only up about 1.5%. And at its core, the Oak Harvest Long Short Fund is a growth fund. So we look more like a growth fund. The value-based Dow index was up over 3%. The Russell, which has been kind of the dog and the laggard for years now, the small caps, was up over 7%, which, is kind of a historically high month for it. So we lagged, but we were green. We made our shareholders money. I'm trying to think. The reason the small caps actually worked was because I think people were hoping the Fed would cut rates. And small caps and the Russell tends to lead at the beginning of those rate cutting cycles. So that played against our fund. But at the same time, we're still in the top 15% year to date within our peer group, top 10% for the last year.
Put the optimist view of that is, with everything potentially underlying going wrong in terms of the types of investments that worked well, was completely the opposite of what we actually do. And we stick to what we say we're going to do as generally large cap growth investors. And all with those headwinds facing us, we still generated positive return.
Yeah, it was a bad style month for growth investors. It was a much better style month for small caps and value, which is a rarity for the last 2 to 10 years, really. So.
Right. And I think one of the worst things we could do, or any professional could do, would be to try to chase styles based on what the market or the economy is doing on any given month.
Very much, yeah. I mean, you can do it maybe with a little part of your portfolio, but trying to change your entire portfolio to make it look like what's working for any given month, you're going to chase your tail. Right. Chase your tail. So what else happened to the portfolio? Oh, single stock wise, some of our winners, it was a very good month to be a buyer of legal products on the internet and not paying an attorney. This little company called LegalZoom, LZ, zoomed higher on much better earnings than people expected and kind of a short squeeze. It was up over 23% in the month. Apple, which is a name everyone knows, was a big winner for the fund. We were long the stock and long calls because we can buy options. So we were long both of those tools. That stock was up 12%. It had been lagging for the year, so it kind of was making a comeback here. Another semiconductor company called Monolithic Power, which is kind of an AI play. That was a strong stock for us as well. It was up almost 18%. Of course, if we talk about the winners, we got to talk about some of the losers. And the losing side was kind of a continued theme for the last 6 to 9 months is on the technology side, the SaaS software space, the likes of things like Salesforce. We had a name called Twilio that actually beat earnings. I mean, I thought it was a great quarter.
It was great.
Stock still went down 18%, so the reaction wasn't what we wanted, of course. And then a lot of large cap tech names that led off the V bottom, things like Meta, and Netflix, I think, even had kind of a weak August. They detracted for the fund's performance. And then we missed on a laser company that we own that was actually making new 52 weeks high and reported their earnings. I didn't think it was bad of a quarter. The conference call, I guess, was incoherent to a lot of people. And the stock is a laser company called Coherent. That stock was down almost 30% over the next 2 weeks. And then finally, I guess on the short side, we were on the wrong side of one of our thematic trades, a little company called Affirm, beat earnings, I guess. I don't even think they have earnings right now, do they?
They beat revenues. Actually,
they beat revenues. So it didn't affirm our current thesis on the weakening of the low-end consumer, but it's a bull market, and it's really hard to short stocks sometimes in a bull market, as Charles said. So we try to do it one stock at a time. And occasionally we have a big move against us, and we move forward from there.
Right. And one thing I would also like to note on this front is back to what Charles had said earlier, where when we have a loser, when we have something go against us, we don't just let it sit there. When Charles talks about culling losers or culling names that aren't working in our favor, this is the kind of thing we're talking about. And these are the decisions that we're making basically every day. What we're going to do with a specific name, whether it's working for us, working against us. And that just never stops being important.
Right. It could be a long that we own that's not working, not producing fundamentally, or it can be a short that we're short that's going against us fundamentally or price-wise. So we can either way.
Right. And so we continue to focus on our high conviction holdings, focus on staying nimble, staying in motion, and focusing on continuing to beat the S&P 500 and our peer group. So thank you, Charles. Thank you, Chris. And thank you for watching. For more detailed information on investing with us in OHFGX, check out oakharvestfunds.com. You can find the link for that website in the description below. Thanks again for watching, and we'll see you in the next video.